And welcome to the Retire Early, Retire Now podcast. I'm your host, Hunter Kelly, owner, Palm Valley Wealth Management. And today we're going to do our first case study here on YouTube. You can also listen to this on your favorite podcasting app, Apple, Spotify, and so forth. But going to do a case study, a common case study that I see with clients. This won't actually be a real client, but these are some common questions that I get from clients and how we kind of go through the process of helping them answer to make sure that they can meet their financial goals, things of that nature. So if you like this podcast, if you find it useful, go ahead and leave a 5-star review on your favorite podcasting app. Subscribe to our YouTube channel, Hunter Kelly CFP, and give this video a like. So let's jump right into it. So today we have Dr. John and Janice Brown. They are both a physician couple making a household income of about $625,000. They're both in their early 30s. They recently graduated residency and just got their first attending jobs. John is a surgeon and Janice is a primary care physician. And so their immediate question that they want answered is, can they buy $1 million home? So I'm just assuming they live in the Jacksonville, Florida area where I am based. And so in order to achieve kind of the home that they would want, it would be approximately about $1 million. So right out of residency, getting hired on, can they purchase this without sacrificing their other goal and their more important goal of retiring by age 55, or at least becoming financially independent where they don't have to rely on work? So these are some questions that we'll ask. And so some other recommendations that I've made to clients like this before is one, helping with their investment design, whether that be through their employer plan or IRAs or brokerage accounts, utilizing backdoor Roth contribution strategies, life insurance analysis, employer benefit selection, and asset location, helping them with their retirement asset location, which is just a fancy word of should they be doing pre-taxed or Roth money in their retirement accounts, or how much should they have in their brokerage accounts via their goals, and making sure that they can optimize for taxes. And before we kind of really dive into this, just a disclosure, this is for educational purposes only. These are not financial recommendations. I'm not your financial advisor. This is just purely to show how I work with clients and case studies. So if something on this podcast episode resonates with you, please seek professional help to get your specific needs met, whether that's booking a call with me or working with someone else. Make sure that you're seeking that professional advice. And so the first thing that I would want to look at when we kind of onboard them and start answering some of these questions is their net worth. And so not that the actual number, the output, the total net worth necessarily means much to me, but I can see kind of a breakdown of where are their assets, what do their liabilities look like, and things of that nature. And so how do we go about calculating a net worth? So if you've never calculated a net worth, all of that is just your assets minus your liabilities. So what are assets? Assets are things like what's the cash in your bank accounts, the cash or investments in your retirement accounts or brokerage accounts, cars, personal assets, real estate assets, things of that nature. And you add all of those up on one side of kind of the balance sheet. And then you take the other side, your liabilities. So these are debts. So in the case of Janice and John, they have about $200,000 of student loan debt from medical school. And they have about $100,000 worth of auto loan debts because they went out and bought 2 cars, which is something I often see when physicians kind of make that first jump into attending physician roles. They go out and they buy a fancy car. So in this case, it's a pretty modest car on both of them, but it is a significant amount of debt. And so how is that going to play into their ability to buy a new house, also be able to retire long term. And so what we want to look for here, some information that we want to gather is one, what's in their emergency funds, how much cash do they have available, right? So if they went out and they put a down payment on a new home, is it going to keep them cash strapped because they took essentially the $75,000 that they have in cash? So if you look here, they have a joint checking, which is probably to pay bills. They have a joint savings, which is their emergency fund of $50,000 if for whatever reason they could not work for a few months. And then they have a joint managed account where they're contributing to, which we'll see in a second, contributing to a brokerage account where they have other types of investments. And so if they were to use that to use for a down payment of, let's say, 20%, well, one, they don't have enough to do that for $1 million home right now. So what do they need to do to get there? And if they did even have the $200,000 between these two or three accounts, if they use that entire $200,000, then they're not going to have a proper emergency fund. So anything like a flat tire or medical expense or any other large purchase, maybe they have a roof repair they weren't expecting because they bought a pre-existing home, things of that nature, that's really going to inhibit their ability to meet those cash needs if that were the case. So the first thing that I see here is that they need to save a bit more to be able to reach that $200,000 threshold, plus have a little bit extra for their emergency fund, which we'll get to in here in a second. And so the other thing that you may notice is that when you add up all of the assets and subtract all the liabilities, they actually have a negative net worth. This is not something to be alarmed about quite yet. Because they are just fresh out of medical school residency, they haven't really reached their peak potential earning, and they're early in their career. So this is something that is very common that I see with young working professionals, is they may have a negative net worth. But if they get on the right track, they start saving and paying down some of this medical school debt, auto loan debts, things of that nature, they would very quickly get into a positive net worth. And then the next question is, well, how much should our net worth be growing each year? And so here, what I like to look at, especially for younger clients, I don't really like doing long, drawn out projections, 20, 30, 40 years, because in some of these softwares, one, they're just going to run, let's say you do even a conservative like 5 to 8% return on average. They're not really going to show down markets or anything like that. So the numbers can kind of get wonky, right? And so what I like to look at is short burst of 4 or 5 years in the future, right? And help make these more immediate type purchases and decisions, and let's be less wrong over time. And then once we start getting into that retirement red zone of call it 10 years or less, then we can really start to look at those projections of, all right, retirement is realistic here and things of that nature, right? Now, that doesn't mean we're still not going to plan for that 20, 25, 30 years out. We certainly are, but we're not really going to take the projection that's 30 years away as gospel, if you will, because there's just so many variables that you can't account for. So when you're young, let's just try to do what we can with what we have, and make sure that we're saving and generating more income, and then the rest will kind of take care of itself as our net worth continues to grow, right? And so what we're looking at here is a 5-year cash flow. The first table here is their taxable investments, which is their joint brokerage account that they have, their retirement account. So they have a 403B and a 401k they've been contributing to for a year or two. And then they have their emergency fund with a little bit of extra cash. So each year they're going to add a little bit to cash to keep up with inflation for their emergency fund. And as their expenses increase, they're going to max out their retirement, both their 401ks and their IRAs through backdoor Roth. And then they're going to add about $80,000 a year to their taxable brokerage account so that they can meet their savings needs. And so what we'll see is that their net worth or their investable assets will grow significantly. One, because a little bit of investment and growth, but mainly because of the amount that they're contributing each year relative to what they have. So right now, adding $80,000 or $100,000 to their investable assets is a very large percentage. But as they move forward 10, 15, 20 years down the road, adding that $100,000 is not as a big a percentage as it will be when they have $2 million, $3 million, $4 million, right? And so we just want to show that, hey, up front, saving is going to be your biggest asset or your biggest thing that's going to determine your success down the road. Not necessarily picking the best stock, picking the best portfolio, whatever that may be. Yes, that certainly helps, but saving and generating more income is going to be your best bet here. And so what we want to look at next is, okay, well, what are they saving? And so this kind of just shows, okay, here's their income. John's making $375,000. Janice is making $250,000. This shows their projected Social Security, which doesn't mean much now. And then from this income here, the $625,000, they're saving $80,000 a year into their joint brokerage account. They're getting 3% match at their employer plans, and then they're maxing everything out as well. And then they're adding about $5,000 a year to their savings account so that they can keep up with inflation on their emergency fund. And so now, what do they need to do to buy a home? What are some things that they need to consider in order to purchase this home, right? So one, they need to create a budget, right? They need to understand what can they reasonably afford. And generally, we want to apply the 28-36% rule, where we want to keep our housing budget, mortgage, interest, insurance, property taxes, our general bills, electric bill, utility bills, water bill, things of that nature, under 28% of our monthly income. And then we want to keep our total debt under 36% of our income. And we'll look at that here in just a second for them specifically. So the next thing, we want to try to have that 20% down payment. Now, them being physicians, sometimes there are physician-based loans where the lender will forego things like mortgage insurance and things of that nature for a lesser down payment because they know their income is fairly stable, and it will be not necessarily guaranteed, but as long as they're working, they know that they'll be getting that paycheck, right? The next thing you want to think of is the type of loan. So do you want a 30-year loan? Do you want a 15-year loan? In some cases right now, people are looking at ARMs, where they are essentially looking at an adjustable rate mortgage, where maybe their rate is a little bit higher now, but they are taking the chances that mortgage rates will be lower 5 to 7 years from now. And then after that first period, that 5-year period, their mortgage would lock in at a lower rate. Now, there's some inherent risk because theoretically mortgage rates could increase after that 5-year period. So if mortgage rates are 6.5% right now and they're 7.5% later on down the road, you could potentially have to lock in at a larger rate or end up having to refinance and things of that nature and put you in a bad spot. So you really have to weigh your options there as well. The next thing you want to consider is location, right? And especially with physicians, they may move around for residency. Maybe they're living somewhere they've never lived before. They don't know the location that well. Maybe they're planning on moving after residency, or maybe they thought they were going to live there. They got an attending physician job. They realized they did not like the town that they were living in, and now they're moving. So if you are not sure that you're going to be there for 5, 10, 15 years, buying may not be the best option for you. Renting may be a better option, right? So you really want to look at the location, know the location based off your needs, whether it's family or nightlife, wherever you want to live, beach, however that may be, but making sure that you're going to be there for a while. And then that kind of ties in with our future needs, right? So we want to make sure, okay, well, in this case of John and Janice, they're married. Maybe they have young kids. Do they want to buy a house where they're going to have to upsize in 5 years, or do they want to go ahead if they have the ability to potentially buy a house where they can grow into and live a much longer time in that house, making it more fruitful for them from a financial standpoint, right? And so if they know the area, they've been there a while, maybe they rented for a few years, they know the areas they like, they know they want to be able to have a house where their kids can grow up, things of that nature, and they're going to be in there a long time, buying would make a lot more sense. But if they're unsure where they want to live, they're not going to be there very long. It doesn't always make sense to buy because you have transaction fees. You have to take care of things that break inside the house. And so those costs can start to add up very quickly. Whereas if you're in a house short term via renting, you don't have to worry about some of those extra costs that are involved with the purchase of a home. And so speaking on John and Janice's specific situation, their current debt to income ratio is at 8%. So with their student loan payments and their car payments, currently 8% of their income is going to pay that debt off each month. And so they are in a healthy spot, right? They have gotten themselves to a point where they're generating a healthy income. They're keeping their expenses relatively low. They're saving about 22% of their income, and they're only using about 8% of that income toward debt. And so they are above average, if you will. They're kind of they're doing well, right? And so now they want to look at purchasing a home. So now the first thing I would discuss with them is, one, they don't have the down payment like we spoke about in previous slides. They need to spend a year or two putting into that brokerage account with some conservative investments, maybe some T-bills, things of that nature, where they can get a little bit of yield, keep that money safe, and reach that point where they can get the $200,000, maybe a little bit more for furniture and extra expenses that they'll have as they move into the house. And then they can purchase that home. And so once they reach that down payment, they're going to look at an $800,000 mortgage for a 30-year mortgage at 6.5%, hoping that interest rates come down in a few years. And so that new mortgage would cost them about $5,000 a month. And if they did that and add that to their debt to income ratio, that would put them about 18%. Now, the other thing that you have to consider is taxes and insurance. And even with adding a significant amount of taxes and insurance, that should keep them under, let's call it 22 to 20% debt to income ratio, which again is well below that threshold of that 28 to 36% that we talked about earlier. So they are well within their means. And the reason why we want to keep this debt to income ratio low is, let's say that their debt to income ratio was at 40%. Well, that's going to take away 40% of their income to put towards saving for retirement, potentially helping kids with college, doing other things, increasing their lifestyle. They're essentially putting almost half of their income in that scenario to paying their house. And we don't want them to be house poor. We want them to be within their means so that they can accomplish these other goals as well. And so the one thing that you want to consider when you're buying a home as well is not only working with your mortgage lender, but also potentially working with a financial advisor, because the mortgage lender isn't necessarily going to think about your retirement goals or other goals that you may have. They're just going to look at your debt to income ratio, some other things like income, and determine, is it within the guidelines of our company? Can they buy that house? Not considering, hey, can John and Janice still retire at 55? Or can John and Janice still pay for their kids' college? Whatever that may be, right? And so we just want to make sure that we're working with someone that is considering their whole situation, making sure that that's working together. So these are some common questions that I answer for clients all the time. And so not necessarily a super complicated case study, since this is my first one. Just want to kind of show you guys how I work with clients, how I help them make decisions, and make sure that we're asking the right questions so that they can come to the decisions and make those decisions that are best for their family. And so if you like this podcast episode, go ahead and share that with a friend. Maybe someone that's buying a house here in 2025 can use this podcast to help jog some questions for them, help get their situation answered, or maybe they need to go work with a professional. But go ahead and share it with a friend. And if you feel like you need help with some of these decisions, go ahead and go to my website, palmvalleywm.com, and schedule a call, and I can help you make these decisions and keep your financial world in order. So thanks again, and we'll see you in the next one. This podcast is for educational purposes only. It is not meant to be financial advice. Please seek a financial professional if about your own situation. Please keep Palm Valley Wealth Management in mind when making those considerations.